All right, everyone, we'll go ahead and get started. I want to thank everyone for being with us today. We always enjoy having you here, and I hope that you get some good information out of this. Today, we're going to be covering employer-sponsored plans. So for those of you that are self-employed or do have self-employed income, some great strategies and good plans to use to get significant tax savings as we come up to the end of the year, and obviously planning on trying to minimize tax liabilities going into next year. There's some really good information to have. Again, please do type all of your questions into the chat box as all audio on your end has been muted. About myself, my name is Alex Perny. I've been with Advanta since 2012. I started my career here doing actual investments for clients. I managed roughly 1,200 client accounts and was involved in many thousands of individual transactions ranging from private placements to directly purchasing real estate and everything else in between. So if you do have any questions regarding the investment side of things, certainly capable of answering those for you. And then for the past 6 or 7 years or so, I've been doing plan setup and establishment and the like to make sure that people are getting the correct types of plans and establishing these types of business accounts for people. So again, had a lot of great experience in doing that. So please do not hesitate to ask any questions. A little bit before we get started, since we are going to be pretty heavy on the tax saving side of things, I just want to make sure everyone knows that this is for educational purposes only. Advanta IRA and our employees, we do not provide investment or tax advice, nor do we endorse or promote any investment products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment arrangement or any type of plan structure. A few takeaway points that I want everyone to kind of carry with you from this presentation today are first that the plans that we're going to cover here are going to have significantly higher contribution limits than traditional and Roth IRAs. So really the point here is to try to show people how they can get much higher amounts of money into these types of plans, which offer fantastic tax savings and pretty amazing tax benefits from the investment side of things, but the immediate tax benefit from contributions and reduction of taxable income for a given year is pretty significant when compared to the $6,000 or $7,000 contributions of traditional and Roth IRAs. There's also a wide variety of ways that you can administer these plans that can really kind of suit each person's individual needs or wants. So that's another really good point. And then there's a lot of different avenues for tax savings. There's going to be ways that you can, let's say you're a sole proprietor or you pass everything through on an S Corp. There's definitely plans that fit that very well. And then also people, if you maybe have a more traditional corporate side of things, or maybe you're filing as a C Corp and you want to try to create personal and corporate deductions, there's also avenues for that, specifically using things like a solo 401k plan. And we'll kind of touch on, which type of plan might work better for each individual when we get a little bit farther on to some case studies, actually looking at someone that, let's say, made $100,000 in a given year, of exactly how much the contributions are going to pass through and where potentially they can see some of those tax savings. So just keep in mind, these are some of the main points that we'd like to kind of hammer home today. A little bit about Advanta IRA. We have almost 20 years of industry experience in doing just this, self-directed retirement plans for small business owners, investors, and the like. Currently, right now, we administer just roughly north of $2 billion worth of assets under administration. And if this is a route that you'd like to go, one thing that we do offer to every single client, no matter if it's a $1,000 account they're starting out with or a $10 million account, is we offer dedicated account management to every single account here at Advanta, meaning that you have a single point of contact that you can come to us, ask your single point of contact, and the Advanta IRA rep any single question that you have, and they'll be able to answer it. So you're not calling through a phone bank, you're not having to go through that kind of arduous task of press 1 for more information. You have a direct line of contact to someone that can actually help you with real questions that you have and get those answers to make the informed decisions that you need to do. So what is an employer-sponsored plan? We're going to be kind of using this term throughout the webinar today to refer to 3 main types of plans: the solo 401k, the SEP IRA, and the simple IRA. But what exactly are these? These types of plans assist employers in retaining employees and helping their employees become financially independent. But more specifically, that's kind of more of the textbook answer of what these plans are. For you as the self-employed business owner or the self-employed individual, these are mainly tools for helping you to create significantly better tax savings plans than otherwise would be able to without these. You don't have to get super creative with your expenses and your capital investments. These are very easy ways for you to create significant amount of tax savings for the revenue that you've generated in a given year without having to get super complex in your tax filings. Now, again, these certainly are able to extend a benefit if you are trying to grow a business, and some of these plans, specifically the SEP IRA, scale a little bit easier than maybe something like a 401k. So also keeping in mind what direction you want to go with your business. If it's going to be something that you are only going to, let's say, just be you and you in the world going forward, then yeah, certain plans, namely the solo 401k, can offer a lot of benefit. But if you're someone that's maybe trying to scale a business and hire additional employees and individuals, there's going to be some trade-offs depending on which plan you want to go with as to what might be the best option, and making sure that you have something that can scale along with your trajectory and also is not going to create any undue burden for administration. Now, 401ks and IRA accounts, for people that are self-employed, this is not something new or exotic. You've been able to do solo 401ks and IRAs since 1974 with the passing of ERISA. So this is not inherently anything new or exotic. These things are well established, and the legislation has been very firm on people's ability to do this. So I'd just like people to know that, a lot of people coming into this might have heard of this stuff. If you're new to this, welcome. But just understand that although we do have a lot of very dynamic things going on in legislation in today's climate, these things have been around for a long time. They are very well established, and it's not something that we can reasonably expect just to kind of go away. So just like to make sure people understand that, especially if you're a little bit new to this. If being new to this does not mean that this stuff is new. That's the point I'm kind of trying to get across with that. So key components of an employer plan. Now, a lot of people coming into this thinking of IRAs, anyone can have an IRA. You can work for a large corporation. Heck, you can even be someone that is unemployed and still open an IRA. Granted, your contributions are going to be limited if you're not employed or making any income, but anyone can just walk out and open up an IRA. There is no kind of threshold or barrier for entry for just opening up a regular IRA. However, with a SEP IRA, a simple IRA, or a solo 401k, what we're calling employer-sponsored plans, you do have to reach a slightly higher testing level in order to be able to open up one of these plans. So in order to have one of these plans, since they are employer plans, you have to have some type of sponsoring business. Now, this doesn't have to be anything like a C Corp. There's no kind of defined parameter of saying, oh, if you have this type of business structure, you can only have this type of plan. For the most part, these are very flexible. SEP, simple, and solo 401ks can attach to really any type of business activity. So if you are someone that passes everything through to yourself as just a sole proprietor, if you're an LLC taxed as a partnership or a pass-through, if you're an S Corp, if you're a C Corp, any of these types of different structures you have for your self-employed income, whatever that might look like, you can essentially establish one of these plans to it. But you have to have that type of income and you have to have that type of structure in order to be able to at least establish one of these plans. If you work a 9-to-5 job and you're just looking to be able to save some additional taxes on the money that you make and thinking, oh, well, if I can defer 25% of my income into a SEP IRA, that sounds awesome. Unfortunately, it doesn't necessarily work like that. And I'll kind of get into a little bit more specifics of how these things, or how you actually look at qualifying the contributions to these plans. But just understand the really key part to this is that you have to have some type of sponsoring business that is going to be attached to this plan. And again, that can be an entity or it can be yourself personally, depending on how you have things structured. And it can certainly be things like LLCs, corporations, sole proprietorships, etc. Again, the point to understand with that is that it doesn't have to be anything as specific as saying, hey, I have this, so I have to choose this type of plan. Now, granted, one plan might make a little bit more sense than the other, depending on your business structure, but there isn't any type of defined parameter saying, hey, if you have a solo 401k, you can't be a sole proprietor. It has to be an LLC or a C Corp. Definitely not the case. So there's a lot of flexibility, and mainly what you want to look at when choosing this type of plan is, one, how you are making money, what your goals are for growing your business, and what type of income is coming in. If it's all just paid out on 1099, if it's as a contract business, if you're something like a realtor or something, there's definitely some inherent benefits to choosing one plan or over another with regard to that. The other part of a employer-sponsored plan are the employees. Now, employees in the context of what we're talking about here are typically is going to be you yourself as the self-employed individual. Employees, again, is kind of just ubiquitous when referring to these plans as the person participating in the plan. If you are a self-employed individual, you work for yourself. You are the employee of yourself. I know it's kind of a bit of a a weird kind of thing to say, but when the context of this, if you hear me refer to something like an employee or an employer contribution, what I'm really referring to is you as yourself as the self-employed individual making contributions. Or when I'm talking about participants, it's the people that, or it's the person that is participating in the plan, which in the context of doing an employer-sponsored plan is going to be you yourself personally. But we also need to understand there's things deemed that are eligible employees. So sometimes you might have someone maybe doing some bookkeeping for you, or you might have someone doing some handyman work for you. Depending on how they're actually engaging with you and how much they work for you is also going to determine which plan you actually might want to choose, because the different plans, namely the SEP and the the SEP and the solo 401k, are going to have different detractions when it comes to having employees, and which one might scale better and which one might let you further exclude people who otherwise may not necessarily want to or need to participate in the plan, but because of Department of Labor regulations, you might be kind of forced in, or you would be forced into offering a retirement plan to those people, which can certainly drive up the expense of administration of the plan. So we'll get into what the eligible employees are in a moment, but just keep in mind, just because you are self-employed doesn't necessarily mean you don't have underneath the law someone that would have to be considered an employee as well. And then also the context of when we're talking about this, the participant and the employee is typically just going to be referring to yourself personally. And then the contributions. Contributions can be voluntary, meaning that you elect to put them into the plan yourself. They can also be what are called non-elective or non-voluntary, meaning that you are electing to essentially, outside of the scope of the employee or the participant of that plan, make a business contribution to the plan as well on behalf of the employee. You can kind of think about this in a more simplified term. If you ever worked for a larger employer and you've had a 401k account, the part that you tell your payroll, say, hey, I would like to defer 5% of my income or 5% of my pay to the plan, and then the business saying, hey, we will match X percentage of your contribution, that first part that you tell payroll to take out of your paycheck is an elective contribution. You are electing to contribute that to the plan. Now, plans such as the simple IRA, SEP IRA, and solo 401k all have that type of elective contribution associated with them. And then also the matching or the corporate portion of the contribution, and we'll get into how that kind of delineates down to the individual here in a few minutes, is the other portion of that contribution. So you need to understand there's kind of two buckets in some plans where money is going to come from, and understanding how that works is also going to be a function of, one, how you have your business set up, and two, how you're claiming that revenue on your tax return. So keep that in mind, that contributions are not always going to be as simple as one might think, but with that additional level of complexity comes the ability to contribute at a significantly higher rate. And not all of these contributions are going to be deductible, and that's going to be a function of you choosing if you want to make them as deductible or non-deductible contributions. Namely, that's just going to be focused on the solo 401k plan. Simple and SEP IRA contributions are always made pre-tax, so if you're simply looking for the ability to make only pre-tax contributions, then both of those plans are good fits. But the 401k, it's an elective difference as to whether or not you take a deduction or not on part of the contribution. So don't necessarily exclude that if you're just looking for tax savings. I'll show you exactly how much power the solo 401k has for allowing significantly higher amounts of contribution with potentially the same amount of revenue when we get into an example of someone making $100,000. But contributions, again, are the other portion of this that needs to be understood. So the sponsoring business, can be yourself personally, it can be an LLC, it can be a C Corp. It doesn't really have any bearing necessarily on determining the plan. You also have to understand that the function of this business plan is to have employees participating in it. You yourself as a self-employed individual are the employee. And then the contribution function of exactly where you have the contributions coming from and whether they are elective or non-elective is also a very important part to understand. But those are basically the three components of an employer-sponsored plan that people really need to understand with this. Now, with these plans, again, we have basically three different options: the SEP IRA, the simple IRA, and the solo 401k. They're not necessarily all created equal, and they all really have their own kind of function or basic basic need that they're trying to fulfill in the workforce. So just understand that they're not all created equal. They can greatly affect the way you contribute cash and administer the plan. So some offer a higher degree of flexibility with administration, some offer a higher degree of contribution limits with potentially less earnings, and then some are better for certain types of businesses. Namely, the simple IRA is good for people that maybe have, maybe you're self-employed, but you have more of a transient workforce. A good example is I had a client that was self-employed that ran a surf shop. Every summer he'd have some high school kids come in and work for him, and the rules regarding the simple IRA allowed him to not have to offer the retirement plan to them. Now, I know it kind of sounds a bit mean to say that, but for all intents and purposes, a high school kid is not going to really want to participate in a retirement plan. They just want to get their money and be on their way. But if you were forced into offering the retirement plan to them, you might also be forced to make non-elective contributions, meaning that the contributions the business is electing to make, if you were to have that participant in the plan, you might also be increasing your cost to having to then in turn pay into a retirement plan for someone that really doesn't want or need it. So again, depending on the type of business you have, might kind of also determine which plan you want to go with. And then also the plans allowing for differences in corporate deductions. Again, that's going to be a function of how you have your business set up as to which one might be the best for you. And then some require employee contributions to receive an employer contributions and others do not. So again, the function of how you actually have the business set up and how you want to year contribute to these plans is something else that you're also going to want to consider. Now, moving money into one of these plans kind of comes in two different ways. Either you can transfer from an external retirement plan, so a simple IRA, a traditional IRA, and a 401k can all be funded from rollovers from traditional retirement plans. So an old 401k, a traditional IRA, can all be used to fund these types of plans. Now, although you can have a Roth 401k, and we'll get into that in a moment, you cannot fund a Roth 401k with a Roth IRA. If you want to use the basis of the initial capital contribution to one of these plans, it has to be made from a traditional pre-tax type of retirement plan. So think your thrift savings plan, governmental 457s, 403bs, traditional IRAs, they can all be used to fund the initial establishment of a retirement plan. You don't have to just start these with contributions, although you are attaching it to a business and your main goal is probably to reduce your taxable income with contributions to the plan. You can also get a head start on how much money you have in here in order to be able to make investments by rolling over funds from a previous plan. And again, remember, it has to be from pre-tax sources. So traditional IRAs, governmental 457s, old 401ks, 403bs, those types of plans can all be used to fund a new self-directed business retirement plan. And the function of rollovers versus transfers is fairly easy. We help you out with that. But again, the point I like to make with these few slides is that you have to have pre-tax funds coming into these types of plans. Now, that's not to say if your ultimate strategy is to have Roth retirement funds, you cannot do a conversion at a later date. Or if you want to start making some contributions to things like a 401k plan, that you can't have a mixture of both Roth and traditional funds in there. Just the initial funding cannot come from a post-tax source, which is very important to understand because some people do get hung up on that. And let's say if you've been saving in Roth IRAs for years and you find the Roth 401k function especially attractive, unfortunately, those do have to remain separated. There is not a way to get Roth IRA funds into a Roth 401k. That has to be started from contributions only. So let's look at the contribution limits for 2022. So here are your options for 2022. The traditional and Roth IRAs have not changed at all. SEP IRAs went up a little bit. So for this year, for a SEP IRA, you can take 25% of your compensation, up to $61,000 of your compensation, and drop it into a SEP IRA. Now, the nice thing about that is that that is a reduction in the amount of money that you are going to be taking home. So you get to reduce the amount of income shown. So let's say you made $100,000 and you contributed $25,000 to a SEP IRA, then you're only going to be taxed on $75,000. And you can further reduce that because the nice thing about a SEP IRA is that it is a component of a traditional IRA. One thing that doesn't get talked about enough is that the basic structure of a SEP IRA, I like to think about it as a traditional IRA on steroids. You have the traditional IRA and the SEP component. They work together, conjoined to be a SEP IRA. But the deferral of your compensation of 25% of your compensation up to 61 grand is also in addition to, not including, your traditional IRA contribution. So in that same scenario of someone making $100,000 and they contribute $25,000 to that plan, so then you're only paying tax on $75,000, you can further reduce that amount of income shown by contributing your $6,000 or $7,000 traditional IRA contribution into the SEP as well. So you get to further reduce that number and pay potentially less taxes, which can be incredibly beneficial, especially if you had, let's say, a lot of income come in a given year. A good example for SEP IRAs is realtors that get paid out on 1099 from commissions. Typically, individuals working and selling real estate benefit greatly from having a SEP IRA because it's very simple, the Simplified Employer Pension, SEP. It definitely helps them to kind of streamline things by saying, hey, here's my total compensation for the year. I can toss 25% of that into a SEP IRA, reducing my amount of income shown, and then also being able to contribute my traditional IRA contribution into that plan as well. So the $61,000 is just representative of the amount of income. So the amount of income you can defer into that plan, but you also get to tack on your traditional or Roth, your traditional contribution onto that as well. Now with the simple IRA, it's going to be a reduced amount of money. So the SEP was pretty much born out of the need for a slightly easier to administer and a higher contribution limit plan, because the simple is the oldest of the IRA type plans on here. So with a simple IRA, you can just basically drop $14,000 of your compensation into the plan a year, with an additional $3,000 if you're over the age of 50, and up to a 3% employer match that can be made non-elective, or a match of the contribution limit or of a non-elective match of the employee contribution as well. Again, the simple IRA is not something I'm going to spend a whole lot of time on, namely because the use case for it is very narrow, and two, because they are not very simple to administer. I kind of find take some umbrage with the naming of that one. It's certainly not a simple thing to kind of understand and wrap your head around. But if the simple IRA is something that would be of benefit to you, we'll get into a little bit more of the specifics of why that might be here in a minute. But the contribution limits are as stated. $14,000 is what you can take out of your compensation per year, plus an additional $3,000 if you're over 50. And then there's some options with regard to the business plan match of that actual contribution as well. The other main component that people get a lot of benefit from, especially with your business owners, is the solo 401k. Now, the solo 401k is pretty interesting because it has basically two different buckets of contributions that you drop into it, and also the fact that these do not have to be made wholly deductible. So if you have some creative tax planning strategies, or if maybe you don't need everything to be deductible and you would like to make some Roth contributions to a plan, the 401k is the only one of the SEP simple is the only one of the three options for employer plans that do offer that to you. So with the solo 401k, you get to defer line item electively up to $20,500 of your compensation per year into that plan. So you just get to say, hey, you know what? I've made X amount of money. I would like to defer that into the plan. And you can either make that front end $20,500, or if you're over the age of 50, you get an additional $6,500 of contribution to that plan. So essentially you have, if you're over 50, $27,000 of just elective deferral to the plan. So if you want to make that traditional, or if you would like to make that, if you like to make that traditionally and have a deductible, you certainly can. But that $27,000 or $20,500, depending on your age, can also be made post-tax, meaning that you're saying, hey, I want to elect to pay tax on this money, and I want to have it be part of a Roth 401k. You can also do that, and that's the only plan that allows for you to do that directly. You can do a Roth conversion of a SEP IRA, or a simple IRA in whatever level that you'd like to, but just keep in mind that this is the only plan that offers you the ability to do after-tax contributions. Now, the other really nice part about the solo 401k is that initial $20,000 or $27,000 contribution is done irregard of how much money you made in a year. Obviously, you had to have made at least that much to make the deferral to the plan, but unlike the SEP IRA, where it's based on a percentage of your compensation, you can get to a higher amount of money contributed to a plan with potentially less amount of revenue with a solo 401k. Now, that's not to say solo 401ks are going to be the best option for everyone. They do get significantly more expensive to administer once you start adding common law employees. So if you do have common law employees, and we'll get into that here in a moment, but if you do have employees, and again, that's anyone that's, when I refer to common law, is anyone that's not an equitable owner of the business or your spouse that is an employee of the business, these do get significantly more expensive to administer because there's some exemptions from the Department of Labor that are offered to self-employed or owner-operated business that the 401k gets to take advantage of on the solo level. So again, the nice part about the solo 401k is that it offers the self-employed individual that nice ability to say, you know what, it doesn't matter, if I made 100 grand this year, I can still put in my $27,000 of my salary deferral, and then I also get a portion of my total earnings. So, depending on how you actually are claiming your taxes, if everything's passing through to you directly, basically you take your total compensation number and you can also contribute up to 25% of that for your total plan contributions not to exceed $61,000 or $67,500 annually. So you get a business non-elective contribution portion of it, which you can think of as kind of the match of that plan, but then you also get just the straight line item deferral of compensation with the $20,500 or $27,000 depending on your age of contribution to that plan as well. So solo 401ks for a lot of people are an extremely powerful tool that offer a great degree of flexibility. But the downside is that especially if you're looking to maybe scale a business and you don't just want to be the one-stop shop for forever, then the solo 401k can get a little bit more, can get a lot more expensive to administer once you start adding on employees. So those are the basics of the contributions and how they're made to these plans. I also put up there the other plan contributions for anyone that might be watching this later that wants to look into exactly some other retirement plan savings like ESAs or HSAs. I put those contribution limits up there for you as well. So the plan options, SEP, simple, and individual 401k. Now, investment options. We're not going to get really far into the weeds of kind of what these plans look like when it comes to investments, but at least for what we offer here, and I'm assuming for the reason most people are tuning in, is that they're interested in not only the great tax savings that these plans might offer, but also what type of investments they can do as well. So we handle really anything that's not on a traded securities market. So if you want to invest in things like real estate, notes and mortgages, private placements, single member LLCs, all sorts of different stuff, you can do that with these types of plans. So you can have these higher contribution limits. And especially if you're a real estate professional, the ability to invest in what you know and understand is extremely powerful when it comes to using one of these plans, because you can get a lot of money into them and you can also help to leverage that with the real estate activities that you're doing as well. So just like to include this as kind of a general catch-all for people to understand also what types of investments they can do when they self-direct their small business retirement plan. Now for some rules. There's certain things that these plans cannot buy, certain people that these plans cannot directly engage with, and some taxes that if you are investing in certain types of asset classes that one plan might be significantly better than another. So what you can't purchase with a self-directed retirement plan. Now, there is a caveat for this, and I should probably update the slide, but certain life insurance products can be purchased with solo 401ks. But as a general rule, term life, whole life cannot be purchased with a retirement plan of any kind. But there are certain life insurance products that solo 401k specifically do have an exemption to be able to purchase. But as far as a rule that holds steadfast to all retirement plans, you can't buy collectibles. So antiques, rare bottles of wine, artwork, stamps, coins, with the exception of gold coins, ones that are traded just on their bullion content value that aren't traded on any type of numismatic additional value. So those types of coins can be held by a retirement plan, but collectibles of any type of retirement plan cannot be acquired or held by a plan, whether it's a SEP IRA, simple IRA, solo 401k, traditional, Roth, HSA, ESA, none of those can hold collectibles. There are certain people that you cannot directly deal with a retirement plan. You cannot deal with anyone that's basically in your direct nuclear family, meaning buying and selling from them. Not to say that if you and your spouse both are operating a quote self-employed business, you both can't participate in the plan. That's not what we're getting at here. This is mainly on whom you can't directly purchase and buy things from. So if you look at your family tree, it's anyone directly up and down from you and your spouse. Now you can directly purchase and sell things to cousins, aunts, uncles, brothers and sisters, all those kind of people you can directly deal with. But it's important to understand who these plans can and cannot engage with. If you'd like some additional information, you can reference Internal Revenue Publication 4975. It's a little bit dry reading, but if you'd like a little bit further information, they delineate it pretty well. Now, there are some specific taxes that certain types of investments, mainly investments involving debt. So if you invest in something that has commercial debt, a lot of people that invest into things like real estate limited partnerships or apartment syndications, commercial real estate syndications will run into, is that if you use an IRA, and SEP and simple IRAs do qualify under that umbrella of IRAs, and there is a loan on the property, then you might be having to face an unrelated debt finance income tax liability. I do a whole presentation on this, and then my podcast is going to be released tomorrow. Also goes a little further into what UDFI and UBIT look like and how to avoid it. But as a general rule, if those are the types of investments you'd like to invest in. So again, limited partnerships, real estate, commercial real estate. A really big benefit of utilizing a solo 401k is that it's exempted from that tax. Again, won't go too far into what that looks like, but just keep in mind that if you're using one of these plans for investment and you're trying to avoid taxes and reduce taxable liabilities, choosing a plan and then getting involved in something that's going to create an additional layer of tax complexity for you is a little bit self-defeating. So the solo 401k, if you're investing into things that have debt, commercial real estate debt, are exempted from that tax. So if that's kind of an end goal strategy, first strategy being tax savings personally, and second strategy being your investment route that you want to take, utilizing a solo 401k offers some very big benefits if you're investing in real estate that's going to have debt, whether that's commercial, single family, what have you, industrial, doesn't matter. If there's debt associated with the property and the deal that you're going to be involved with, utilizing a solo 401k offers a significant benefit to doing that. So just keep that in mind. I like to leave that in there, although I do kind of reuse the slides through various presentations, that solo 401ks do have a very big benefit when it comes to those types of investments. Here's basically just an infographic of the people that you can and cannot deal with. Just kind of lays it out nicely. Again, and remember, these are people that you cannot directly transact with, meaning buying and selling from these specific individuals. I'll leave this up here for just one moment. So let's get into which one might make more sense for you as the business owner. And keep in mind, and I'll get into the contribution deadlines here in a minute, that you do have some time. You don't necessarily have to have these plans done and dusted by a certain date with some tax updates that happen with the Secure Act, but it's typically a better time than any to kind of get these things in place, so that way you can be ready to make investments, especially with some market conditions changing. There might be some deals to be had, and also just kind of getting ahead of potential tax liabilities that you're going to have, especially if you're making quarterly tax payments. You can reduce the amount of income shown to maybe help alleviate some of that pain. So which one should you choose? So with a 401k, there's no solo 401k, there's no discrimination testing for an owner-only business. Now, discrimination testing is essentially required Department of Labor plan testing that has to be done by a third party to make sure that you are offering the plan to any eligible employee. Now, that to be said, if it's an owner-operated business or a self-operated business, then you don't have to do that, which is kind of, again, when I got to the point of choosing a plan a little while ago, stating that 401ks get a little bit more expensive to administer when you scale a business. That's what I'm talking about. If any rank and file employees are present, then special testing must be done. Simple IRAs can cover up businesses of up to 100 employees, and then SEP IRAs can have any number of employees. So if you have a business that has employees, or you maybe are looking to scale your business to a certain level at a future date, then a SEP IRA might be a very good choice for you, because you always are going to have to weigh the plan administration cost with the tax savings to see which one might be the best fit. So that's kind of what you're looking at. A 401k can scale infinitely, but the cost associated with scaling a 401k can be directly related to the amount of employees you have. But if it's always going to be just you, owner operated, only the buck stops with you, or it's just going to be owner operated with a few partners, or just you and a spouse, a solo 401k can definitely offer a great benefit and also be exempted from that plan discrimination testing. So impact of other employees. So what type of employees are able to be excluded from an employer plan? Anyone under the age of 21, non-resident aliens, and union employees covered by collective bargaining. Those people can automatically be excluded from a retirement plan in general. But to drill down further into what types of employees must be included, we have to look at the plans individually for what their testing requirements permit. So with a solo 401k, those people that have worked 1,000 hours per year or at least 500 hours per year over 3 consecutive years have to be included in the plan. So again, if you're someone that maybe has a bookkeeper or someone that does some handyman work for you, you need to really look at how many hours these people are working for you when it comes to establishing a plan, because the last person you want to run afoul of is the Department of Labor when it comes to maybe having not included someone that should have been included in a retirement plan. The penalties and then also having to go back and then make retroactive contributions to a plan can be painful at best, and let's not get into what it can be at worst. So with the solo 401k, again, 1,000 hours per year, or at least 500 hours per year over 3 consecutive years. A SEP IRA must include any individual that has worked at least 3 of the last 5 years. That also meets the individual total, the individual requirements listed above of being over. That can be over 21, non-resident alien, and a unionized employee. And then a simple IRA are those who have received at least $5,000 of compensation during either of the last 2 years. So a simple IRA, again, tweaks it even further to say if you have anyone that is making a certain amount of money has to also be included. So again, understanding which plan to choose is also not only just going to be a function of how you want to make your contributions, but also how you run your business. So looking at if you have employees, what they are. And again, if these people are being paid out as just independent contractors or service providers, they don't necessarily have to be included. But if you are including them on payroll and they are considered a common law employee for you, then you definitely need to also factor that into when it comes time to choose the actual type of plan that you want to have for your business. So let's get into some SEP and simple advantages, and then we'll also look at the solo 401k as well. These types of plans are just off the bat going to be less expensive and easier to administer, just from the simple fact that they are basically kind of fall mainly under the realm of IRS regulations. They do get into the Department of Labor to a bit, but not as much as the 401k. And mainly it's because contributions are made to IRAs. They're very specifically codified within the Internal Revenue Code as to what types of accounts these are. And basically, you're just making cash contributions into IRAs for the specific individual participating. Another big benefit of this is that there's no fiduciary liability on the behalf of the business to the plan. So the individual account holder or employee is the one that ultimately has the responsibility of any investment choices and plan administration of that once they receive the capital into the account from the contribution ratios or whatever's been established. So again, that helps to reduce the administrative overhead. It reduces the liability exposure to the business owner of not having that fiduciary liability. The individual employee can choose the IRA custodian. Typically, the SEP IRA will be offered, or a simple IRA will be offered if you have employees. And just pick an administrator, and that's where they have. But they are allowed to choose if they want to administer at a different custodian. They certainly can. There's really no additional overhead to you as the business owner if you have employees to allow them to do so. And there's flexible contribution and plan distribution features. They're also portable from one custodian to another relatively easily. With a 401k plan, you're always going to kind of be, and I hesitate to use the word stuck because, we do administer these plans and we'd like to, make these as easy as possible. But if you do have employees participating in the plan, they can't choose to administer their 401k plan at a different custodian. You're always going to be using the same third-party administrator or TPA plan document provider for everything going on within that plan. And then employee contributions, only to those employees with more than 2 years of service with a simple IRA and then 3 years of service with a SEP. So those are some of the advantages that the SEP and the simple IRA offer. So I got a question. Let's see. Can you have a Roth SEP? Fantastic question. So let's get into that a little bit. Can you have a Roth SEP? So just from kind of the general textbook answer would be no. But that's not to say that you cannot convert your SEP contributions to a Roth IRA. So let's break that down a little bit farther. If you make a SEP contribution, so let's say you made $100,000 in a given year and you contributed $25,000 to that plan as your salary deferral to the SEP IRA. You can take that $25,000 and do a Roth conversion of it immediately upon making the contribution. So you take that $25,000 that you wrote off on your taxes, and then you immediately claim it again as income. So instead of claiming $75,000 of income, you then in turn claim the full $100,000 of income, because you got, basically have offsetting additional income and also an offsetting deduction, so they kind of cancel each other out. So if you're okay on paying taxes on that $100,000, then yes, you could, effectively, I'm making air quotes here that you can't see, you can effectively make a Roth, you can make a SEP contribution into a Roth, but it has to go through the SEP first. You can't just automatically say, hey, I'm just going to drop my SEP contribution into a Roth IRA. There's some mechanisms that have to happen first, but you can certainly get those funds into a Roth IRA if you do choose so. But it doesn't have, the SEP IRA does not have that direct functionality like a 401k does to just claim, say, hey, you know what, I'm not going to take a deduction for the money going in. It's going to be after tax, and it's going to be considered Roth 401k from the get. You have to do a little bit more work. But again, to your point, you can get SEP contributions into a Roth IRA. There's just some additional steps that have to be made, and you have to understand that you're not going to, get that tax deduction if you decide to dump it into a after-tax plan. Yep, the question understood. So no SEP Roth, only SEP contribution can be converted to a Roth IRA. Yep, you got it right there. So let's keep moving on. If the slides would like to move. All right, here we go. So 401k plan advantages. And again, I'm referring to this as a solo 401k. So you have all the benefits of traditional business retirement plans plus higher funding limits. You can defer a larger amount of your earned income with employee and employer contributions. You have the ability to roll over other retirement plans into this. And keep in mind, the only rollovers that you can do into a solo 401k have to come from pre-tax plans. So old 401ks, traditional IRAs, 457, 403bs, anything that has pre-tax money in it, you can roll over into a solo 401k plan. You also have the added benefit for the 401k of access to tax-free loans. So unlike any other type of IRA, a 401k, you can actually, if you have, let's say, personal need for money, but you don't want to, permanently extract those funds from the retirement plan and pay taxes and penalties, you can borrow against your 401k. Essentially, you sign a promissory note to the 401k, and you can borrow up to $50,000 or half of your vested balance, whichever is less, and you have to repay it in 5 years and make at least a quarterly payment. So the 401k also, to the participant of the plan or the business owner, offers some additional access to that capital. Let's say your business runs into funding issues and you contributed a lot to the 401k. You can pretty easily get out that money and help to cover shortfalls in funding for your business or personally. We just had a huge hurricane come through here in Florida. If you had some expenses that you need to fix your roof before the insurance comes through, you have access to that type of capital very easily, and you can, again, that gets repaid back into the 401k plan, so you don't deplete it. You get to put it back, and you don't have to pay taxes and penalties on those loans, which is a very powerful tool and something that, again, is not offered by the SEP or simple IRA. You also get to escape UDFI or UBIT on leveraged real estate investments. So especially for those of you that are interested in investing in things like commercial real estate or real estate syndications, the solo 401k is a fantastic tool for additional tax savings, not on just your contributions, but also on your further down the road investment opportunities as well. The solo 401k is very, very powerful. You also have pretty cost-effective administration for the solo 401k. So if you don't have eligible employees, the solo 401k is a fantastic option for you. And you also have the ability, unlike with any other of the plans, to make direct after-tax contributions to the plan, so you can have a Roth 401k as well. Looks like we have a question. Let's see, I have several real estate multifamily properties that sold this tax year. As someone over the age of 60 who currently has a self-directed 401k with Advanta, what is the maximum contribution? I am self-employed with no employees. We will get into that. Oh, actually, we did earlier. Essentially, it just is going to depend on how much money you had. So you can contribute up to 25% of your total compensation, not to have So you can contribute $20,500 of your compensation as just an elective deferral. If you're over the age of 50 and a half, you get to add an additional $6,500 to that, so $27,000 on the front end. And then you also get to contribute 25% of your total compensation, or of your, depending on how you file your taxes, of your net operating income of your business, for the total plan contribution to not exceed $61,000 or $67,000 per year. Moving on, if it wants to participate. Okay, so here's what this looks like, and this is really kind of the cool slide that I like to bring up, because it really kind of shows just how powerful each one of these plans are in their own right when it comes to choosing which one might be the best fit. So how much can you contribute into a plan? So John is a sole proprietor whose 2022 salary is 100 grand. Which plan is right for John? Well, with a simple IRA, he can contribute up to $17,000 of total contribution to the plan. It's a $14,000 salary deferral plus a $3,000 employer match. With a SEP IRA, again, this is going to be extremely easy. He just takes the 100 grand, multiplies by 0.25. He can contribute 25 grand to that plan, and then he's only going to be paying taxes on 75 grand for that given year. So he gets that cost savings of reducing his taxes, and then also of being able to contribute 25 grand to that plan. Keep in mind, he can further reduce his taxes if he wants to contribute his $6,000 or $7,000 contribution to that plan as well. So with the SEP IRA, you're getting into the mid to low 30s of total contributions to that plan, all tax deductible. Keep in mind, there isn't a functionality to make a Roth SEP contribution. Now with the solo 401k, we have a very big jump in this amount of contribution. And again, he can play around with this. The nice thing about these types of plans is that you're not locked in, with the exception of the SEP, with the exception of the simple, the SEP IRA and the solo 401k do not have any type of lock-in for saying, hey, you have to contribute at this rate every year over year. So if your earnings fluctuate, if you want to increase or decrease the rate of contribution to these plans, you can do that with the SEP and solo 401k. The simple IRA, you are going to be locked in for 2 years on the employer side of things. So just keep that in mind. The simple does have some constraints on that, but the SEP IRA and the solo 401k, if you want to contribute at a 25% rate for the SEP IRA 1 year, do 10% the next year, or anything in between, 100%, you're just fine to do that. The solo 401k offers a significant jump in the amount of money that can be contributed for John on a given year, just by the functionality of the 2 buckets of contributions. So how do we get to $45,500 for John for this given year? So what it looks like is that he's under the age of 50, so he can contribute $20,500 of salary deferral. So his compensation was 100 grand. He decides to kick in the full deferral of that, 20,500. That can be made either Roth or traditional, but let's assume that he wants to just really reduce his taxes down, because remember, it's not how much you make, it's how much you keep. So he wants to really reduce his taxes. So he contributes $20,500 into the plan pre-tax, and then he elects to have the additional contribution of 25% for the quote non-elective or business match made to the plan as well. So he elects to put in $25,000 of additional capital into the plan. So he gets to $45,500 a lot easier than having to have significantly higher amounts of earnings like with the SEP IRA. The SEP IRA could certainly contribute at a higher amount than $45,500, but you have to make a lot more in order to be able to make that higher contribution. The solo 401k is very good for people that maybe aren't making tons and tons of money in order to be able to maximize their contributions to these types of plans. Now let's assume that John was over the age of 50. What do his catch-up contributions look like? So the simple IRA, he gets to plug in an additional 3 grand, so he could make a $20,000 total contribution. The SEP IRA, there is no catch-up. I would say that there is a slight caveat for that, because the traditional IRA does have a $1,000 catch-up contribution at 50 and a half. So in reality, if you're also using the SEP IRA in the most complete form with looking at it in conjunction with your traditional IRA, you do have a $1,000 catch up if you're over 50. In the solo 401k, you get a $6,500 salary deferral bump if you're over the age of 50. So again, assuming that John is over the age of 50, he's getting into the low 50s directly with that, with only making $100,000 a year. So he can basically plug away almost half the income if he doesn't need it, and really reduce his taxes, because the taxes on 50 grand are significantly less than the taxes on 100 grand. So he gets to keep a lot more of his money and also be able to invest that tax deferred and make some really great returns and grow his capital for retirement at a very good rate because he's self-employed in this instance. Okay, yeah. So someone asked, can you repeat the extra 7K you mentioned on the SEP? Yeah. So it's not on the slide, but I'll go back over it. We are running up a little bit on time, but we're at a good place. So with a SEP IRA is a component of a traditional IRA. So you have a traditional IRA and you have a SEP component. So the $7,000 or $6,000, depending on your age, is that additional traditional contribution you can make. So your SEP contribution is going to be 25% of your compensation for a given year. And that goes into your SEP IRA. But remember, you can also make your traditional IRA contribution into that same SEP IRA. So essentially, effectively, you get an additional $6,000 or $7,000 per year that you can contribute into a SEP IRA when you factor in the traditional portion of that plan. So that's where that came from. It's not listed up here because it is a little bit more nuanced. I should probably update the slides since I always bring that up. But that's where I'm getting that additional $6,000 or $7,000 of a contribution limit for the SEP IRA. The simple IRA does not have that. The simple IRA stands alone. Again, terrible name for a plan because it is extremely complex to administer and the rules are very nuanced. The SEP IRA, a lot easier to understand, much bigger fan. So I also mentioned that there's different ways to administer these plans. Not all of them have to be the traditional custodial model that you're kind of used to. You can, especially specifically with a 401k, you can either elect to do the whole plan yourself. We call it a do your own here at Advanta, or you can have us act in a more traditional, administrative capacity. We're not the custodian of a 401k specifically and legally, the trustee is, but you can have more traditional engagement like you would with an IRA with a solo 401k. Or you can do your own model, which can be self-directed. People like to call it checkbook control. So the cash and assets are administered by Advanta or directly by John in a 401k plan. In both scenarios, assets and investments are held in the name of the plan. So if you want to do everything yourself, you want to try to reduce costs because a do your own model is significantly cheaper. And if you're someone, let's say, that's very good with bookkeeping and you understand the rules, if that makes more sense for your business, then yeah, you can administer your whole plan yourself, have a separate bank account, basically just rent the plan documents from Advanta, and not have to really engage the administrator at all. You don't get to do that with a SEP or a simple IRA. You do have to have engagement from the custodian. But the 401k, with the way that they're set up and having a trustee, which is you as the business owner, do offer some greater degree of flexibility. So just understand that if administration of the plan and the assets is something that is of concern to you and you really like to have very tight control and take full responsibility for everything, the 401k offers that additional degree of flexibility and option to you as the business owner. And that's pretty much it. I want to open it up to any questions. A few things, if you do have any other questions, we have great events. We put on events twice weekly, Tuesdays and Thursdays. We also have a podcast on Wednesdays. We'll be going over UDFI and UBIT liabilities. Essentially, if you're interested in understanding more about how the 401ks are exempted from that, check out our podcast, the Alternative Investing Advantage podcast, coming out tomorrow. If you're looking to raise capital or if you're looking to find investments, we have a great networking event every other Friday. It's coming up this Friday called Pitch, Promote, and Prosper. We'd love to see you on there. We normally get between 40 and 80 people on there, all over the US, sometimes even the world, that are pitching what they have. We let anyone pitch an investment or say what they're looking for. If you have questions, you can get the power of groupthink working on that for you as well. So I'm up to questions. We had some great questions here. Let me so we have a question. Can you self-direct the SEP? Yeah, so anything that I covered, I apologize if that wasn't clear enough, but yes, any type of plan that we covered today can all be self-directed. So SEP IRA, simple IRA, solo 401k, education savings account, IRA, all those kind of plans can be self-directed. And the cost for administrating solo 401k vary widely because it depends on what level of service you need. At the base, it starts at about $300 a year. And then it can kind of scale up from that because solo 401ks do have different reporting requirements than IRAs, and depending on how much money you have in one of those plans also dictates how much reporting needs to be done, not only just employees. Like I said, the SEP IRA is a very simple way to get into business retirement planning, but the solo 401k does have some extra degrees of functionality. And also one other thing I'd like to mention is that these plans, you can make previous year contributions with these plans. So you can establish a plan this year or early next year and still make a previous year contribution, but it has to be done before you file your taxes for the business. It used to be with a solo 401k, you had to establish it before year's end, but I would always encourage people, now it's never too early to start looking at your tax planning and starting to get a good idea of what you want to start getting sheltered from the IRS when it comes to how much money you're going to have to be paying taxes on. So just keep that in mind. It's never too early to start with this kind of stuff, but you don't have as many constraints. You can still establish business plans, at for a given year, following year. But if you are filing on an augmented um, financial year, then you would need to have the plan established and have the contributions made before you file taxes if you're filing on an adjusted financial calendar year. Have a question. HSA account, what can you do with the money contributed? You can do anything that you want to with it as far as self-directed investments. You can invest in, more traditionally stocks, bonds, mutual funds. You can invest in real estate. I have a client here locally to me that owns 3 or 4 rental properties in his HSA account, which is pretty interesting. Another question, if I just started consulting business this year, can I start and fund the SEP and solo 401k? So you have to choose one or the other. You can't have both. You have to choose either a SEP or a solo 401k. And if you just started the business this year, absolutely. It doesn't matter necessarily when the business was started. You can establish the plan, just so long as the plan doesn't precede the business. So the business has to have been in place, and then you can establish the plan. So chicken and the egg. Business comes first, then the business plan. But if you started it this year, you don't have to wait until a certain given time to make the contributions to it. You just have to obviously qualify the contributions to the plan. Is there a risk of the IRA stating you don't have a business but a hobby? Well, that all comes down to how you file the income for that activity. If you're making over $600 a year doing anything, you have to report it to the IRS. Hobbies turn into businesses all the time. I don't think the IRS really cares so much, as long as you're paying taxes on the money that you're making on that. But again, I would really kind of defer that to a tax advisor. But for the most part, so long as you have income that you're claiming, from a self-employed or a sole proprietor type activity, yeah, you can defer that type of income into a retirement plan, but you got to be claiming the income as taxable income in order to be able to quantify that type of contribution. All right. Well, looks like we're coming up right on the 1 o'clock hour. Any other questions? I'll give a few moments for people to type those in, but do appreciate everyone being on with us. Hopefully everyone got some good information and can make some good informed decisions about the business plans that they may want to get going in order to save some taxes this year. Because if one thing is true about taxes, is they always keep going up. All right. Well, no other questions. We'll go ahead and end it up here. Thank you, everyone, for joining with us today. I really appreciate you being with us. I enjoy doing these. Hopefully you got some good information. If you have any other further questions, feel free to reach out to me directly. I am happy to answer any questions or get you pointed in the right direction with anything that you need. Thanks, and have a great day.